I have ChatGPT pulled up.
Little chat.
And we're prepped.
So the question I have for you today is investing in real estate in 2025 a legit viable option?
Mm-hmm. Wait, is what?
Investing in real estate in 2025 a legit viable option for retirement?
Yeah. I mean, I think no question. The weird thing is, which we've talked about in multiple episodes, is it's no longer the cool thing to talk about, investing in real estate.
Mm-hmm. Specifically in our marketplace.
Right. You know what's interesting, though? There's one strategy that's cool to talk about, but is highly risky, and this is where this whole question is like multifaceted, but seller financing.
Oh, yeah.
People are obsessed about that, especially aggressive real estate investors are stoked about that because they are getting better terms, getting a lower payment locked in. But we've now had 2 clients recently have the due on sale clause actually executed on, and they had to scramble. And they're now, like the client I dealt with most closely was paying like $1,500 more per month for the house. And once we got the appraisal back, we recognized in a matter of 8 months the value of that home from what he agreed to pay for it as an off-market seller finance deal compared to right now where we get a legit appraisal and do the due diligence that a lender requires to make sure the collateral's there. The value actually came down $50,000 from what he paid for it.
Well, and he might have been paying more for it anyways than it was worth.
He knew he was.
Just because of that shiny rate. Yes, attached to it.
He agreed.
I think there's so many people out there like that right now.
For sure. They're agreeing and they know they're paying more for the asset.
Because of the monthly cash flow.
To essentially buy the cash flow. But it's like, well, if you're buying $800 a month in cash flow at a cost of $50,000 on a $500,000 house, so we're talking a 10% cost on the asset, like you are losing your butt.
Yeah, I know someone that in the past 2 years, they've acquired over 20 doors by seller financing here in the state. And they've had one similar situation. Luckily, they owned a bunch of other doors, too. They were able to pull from some equity.
Liquidate and just pay that off.
Pay it off. But if you're not in that scenario, it can be super risky, to your point.
Yeah. Well, and even for that, now the analysis of the investment decision that was made, all of that goes out the window for that person because they weren't expecting to now go liquidate with HELOCs or whatever, which is more expensive debt than if they would have just financed it regular. When they originally bought it. You understand what I'm saying?
No, I get what you're saying.
Now the whole assessment of the return on investment completely changes.
That's exactly. It's like, what's the most, I guess, and it probably is person to person, but to me, cash flow is not as important. I'd rather bank on appreciation.
Right.
Yes, cash flow is nice. I don't want to be paying out of my pocket every month, but I guess what is more important?
And you do have to make, to your point, I think it's different. You have to make a decision. What type of investor are you? What can you sustain? You have good income and consistent income that's likely never going to go away. So it's like, okay, cash flow is not that critical. It's more wealth creation. Some people, it's like cash flow is really critical, but you can have a micro lens on cash flow and get stuck in a really bad position. Like my client was not as lucky as yours. They're going to have to legit write a $40,000 or $50,000 check or more maybe out of pocket unexpectedly within 30 days of notice to get that loan paid off. And that's a sketchy thing.
Yeah. And for those of you who don't know, a due on sale clause is meaning the lender caught wind that the owner of the note is not really the owner anymore.
And it's crazy because that particular bank that on my most recent one, because yours was the other one that we had done here in the branch, my most recent one, that bank had pulled their whole mortgage servicing portfolio to double check.
Because they had other. Oh wait,
so
let
they
me make sure I
called
understood.
a bunch of them do.
They had multiple loans with that bank.
This borrower didn't. This bank, they talked to the legal department in the bank.
I get what you're saying.
This bank went to a bunch of clients.
So it was like a phase for them. Like, okay, we got to see. Do you think because banks, they want those low notes off the book?
For sure. Why would you want to be carrying a
2%
3
rate,
or 4% or 2% mortgage rate?
When you could go out and get 7%?
And it's locking up banks' liquidity, so their lending restrictions are different. Like, it's not good for the banks. And I think more of that's going to happen.
I think you're right. Well, especially because you get people that are trying to be sneaky. They're like, well, if you do it X way, they don't report to the servicer that something was changed. But if they're proactively looking into it, you're going to be screwed.
Exactly. And that's what this bank did, which is totally unexpected. And I mean, I've been thinking this for years. Like, you better be prepared if you're doing a seller. I mean, I think seller finance is great as long as you're prepared, like your client was. But if you're not, it could screw everything up. Like, this guy might legitimately have a foreclosure. He doesn't have a $50,000 check to write to get this loan done. So now he's scrambling, trying to find a hard money lender to give him a loan.
Right. I think I said on that one. He didn't have a property he could leverage.
He rents his primary home, which is crazy.
Yeah, which I think goes to show, I think investing in real estate, if that's your retirement plan, it has to start with the primary.
For sure.
It's a no-brainer.
We do an entire home buyer presentation centered strictly around
purchasing,
buying primary residence. And you turn into a multi-millionaire, and you buy 1 or 2 or 3 homes ever in your life.
Yeah, I think that's the best way to do it, because number one, you can stay, it falls into our holistic mortgage plan, which we've talked about time and time again, but you can stay more liquid, put down just 5% instead of, or 3.5, depending on what program you're doing, instead of the 20% down required for a investment property. Rates are going to be better by like a full percent, which if cash flowing in the future is important to you, that's, I mean, the better terms are going to be way better. Of course, you do have to occupy for a year. It has to be your primary for a year. But after that year's up, you could turn it into investment, no problem, and then rinse and repeat.
Yep. And I think that's our favorite strategy. So the question, can I retire off of real estate in 2025, or can I become a millionaire with real estate in 2025? And I would say unequivocally, for sure, yes. You've got the big talking heads, that the big prominent figures in real estate, that what's the guy that I'm thinking of?
Yeah, Berkshire Hathaway.
No, guy? Yes, him. No, but
that's what I'm trying to think of right now.
The 10x millionaire guy.
We just read his book.
Yeah, no, but not him.
Oh, you're thinking Gary Keller?
No, my
You're not thinking of the big red book. Who are you thinking of?
The big, huge, loudmouth real estate investor.
Oh, Grant Cardone.
Grant Cardone.
You've got throw out every name you got there.
You've got like people like Grant Cardone that's like, don't invest in real estate. You're an idiot if you buy real estate. The reality is they're promoting interest and excitement around the way they invest in real estate, which is actually what most people don't recognize is those types of funds. Well, the guy like Grant Cardone, he's making 20 or 25 or 30 or more % of the profit based on your money that's going to be invested. So he's highly motivated to encourage you to not invest in your own.
So he makes more.
Right? And there is, like, I do that. Yeah. And I've been talking to you a lot about it. I've kind of converted into investing in those types of deals, frankly, more than just single family deals. But for the first 17 years of my investing in real estate was regular one-off deals. And I was able to create enough wealth over that I could invest into bigger things that made a lot of sense. But we talk so much about just the simplicity. And I said, I got on a tangent here, but unequivocally becoming a millionaire and creating a path to retirement, for sure you can do in 2025. It's not the pretty girl at the dance right now, and nobody wants to talk about it. People are downplaying it. Rates suck. Everyone wants to just like have clickbaity stuff like, oh, home prices are going to drop. How long have we been hearing that? It's like literally years. Shut out the noise. And then let's look at the real legit strategies. And to your point, I mean, I think that might be the most important thing to talk about. We should just kind of dissect what our cycles look like, where you want to acquire your dream home and or a portfolio of real estate, and how that creates a multi-million-dollar path towards retirement.
Well, yeah, let's run it.
Yeah, let's.
So what's the median? Like let's do it at 600K, because it's about the average.
Well, I've done this recently, so I'm actually just going to pull up the presentation that we most recently did.
Do it. And while he's doing that, I think seller financing is still a smart strategy. If you can do it and you find the right deal, 100% go for it. Now, what I don't agree with is paying more than what the appraised value would be. So,
or not egregiously more.
Yeah, exactly.
Like,
exactly.
If you're going to pay a little premium to get that,
and you still have a due diligence period when you're under contract on a seller finance property. You can schedule your own appraisal. Schedule an appraisal.
For sure.
Do your due diligence to make sure you know it's worth what you're paying for.
Yeah, that's smart. I agree with that. So I'm still pulling this up.
You're good.
So what you were just saying with seller financing, and I just want to put a plug into our entire philosophy, because the way we guide our clients is we believe in clients for life, and we guide them thinking through these risk factors. And I would say that's one reason why, if you want long-term sustained success in real estate, you need to have probably at least a couple of very experienced, legitimate advisors. Oftentimes, that is the lender and that is the realtor. And even if you're not getting lending because you're doing a seller finance deal and it doesn't require a lender, still use them to bounce ideas, because we think through the logic of the deal and the risk.
Just even the little nuanced stuff.
And we think through it very differently than a realtor would. And we may have strategy that completely shifts it and makes it more profitable or impacts negotiations. Like you said, just get an appraisal. You may as well, that might be something a realtor's just not thinking of, because it's not they're like, hey, I can just run a CMA.
Yeah. And of course. And they're focused on getting you the best deal possible.
Right. So it's like totally different. But our whole philosophy is optimize leverage. Well, seller financing with 0% down and better rates than you can get with current market rates, that is optimizing leverage. So maybe that is the right way. Next step, though, is mitigate risk. And this is what this client of mine and your client, frankly, missed. Complete that whole pillar they missed. And the third pillar is maximize wealth, which you are on a seller finance deal or on a closed, these clients optimized leverage and attempted to maximize wealth. They miss the most, I would say, the critical A1 piece, which is mitigate risk. Because if you don't do that, optimizing leverage was a waste of time.
Well, and maximizing wealth. Think about it this way. How that client, how much over did...
Dude, it was like 50,000, like 10% more.
So even if and how much were they cash flowing from it, you think?
I'm trying to remember. It was like $1,000 a month.
Okay, so I already forgot. How much?
50 grand.
50 grand. So 50 months. 50 month break even period.
For them to make that, exactly. Exactly. And it's like, had you just, imagine this. Right now in this market, if you're not trying to do a seller finance deal, because a lot of sellers can't do that, you can just go negotiate a 10% discount on the house from market value.
So then,
so you finance it with worse terms, and maybe you're negative cash flowing
a little bit. Oh, I read your mind. Yeah.
But it's like you made the 50 grand day one.
Exactly. So let's unpack that a little bit. He's saying instead, if there was a deal out, of course this has to be very specific, but if there's a deal out there where you can negotiate 10% off, well, now, yes, you're not going to be cash flowing on maybe even negative cash flow, but calculate the break even. Could you then front the money for X amount of time? And in that X amount of time, is there an exit strategy, or is there a way for rates to come down? And then is there a target rate that you are looking for that when you do refinance, it does make sense?
And to the point, we are thinking about this because we are lenders and our train of thought is different. And it's different than a realtor, and a realtor is going to have counterpoints that to us. So you do need the group of advisors for sure, even if you're not doing it.
And those are our favorite clients too.
Absolutely,
that like to game plan because we get the most enjoyment. It fills our bucket the most. Like I just had a client this week that they're not doing a loan through us. They're getting private money at better terms that we could offer, but they needed my advice because they were going to be over 10 finance properties at that point, which can screw them on getting
future deals.
Deals, yep. Which these guys, they could retire based off the amount of deals they've got right now, but they don't want to stop here. They want to create generational wealth. So just having that little bit of input with my help is going to set them up forever.
Right. You have a long-term strategy, and that's what we are. We're not like these transactional chumps that are like, well, you got to do a loan, and we won't talk to you. We try to create that dynamic relationship, be trusted advisors, and when the opportunity's there, yes, we're going to make some money. It's how we make a living. But the reason we have done this for now, I'm going on 17 years, you're going on 7 years. We've been able to sustain this on a business long-term because of the quality advice that we give in any circumstance. So anyway, we don't need to make this a full commercial about us, but I do think that's critical to know.
Agreed.
That you got to take a holistic view on this, and you have to mitigate the risk. And I would say unless you're dealing with people, and I would say minimum 2 advisors, 2 kind of probably differing advisors.
Yeah, yin and yang.
Exactly. That have done hundreds of deals. You need that level of support. You can't work with your cousin who's a realtor and has done, a few deals. You can't work with your buddy who just got their mortgage license or does refinances from their basement. I'm sorry, they're just not going to give you the advice with experience backing it that we will. I mean, I've personally invested in tens of millions, if not more than that, in real estate. You have been in millions in real estate, and we've helped hundreds of millions of dollars in real estate investments supporting our clients. Hundreds of millions a year is what we support. Like you can't put a price tag on that level of kind of advice and thought and foresight.
Exactly. And I don't think that
Does your home and auto insurance seem to go up every year without fail? Mine did too. I thought this was just the way the insurance industry worked until I found my friend Alan Johnson with American Family Insurance. After more than 15 years with the same insurance agent, he saved me over $3,000 per year when I switched. I refer all my family, friends, and clients to him, and their experience is similar. Great rates and a great experience. Call Alan for a free quote today at 801-708-2962.
Because let's face it, you don't need to be just some mega real estate investor to retire off of real estate, which we're going to dive into.
Yep.
You only need a couple of properties. So only needing a couple of properties doesn't mean you just use Joe Schmo. We still like game planning with the people that only own a couple with the same amount that it's, the people that buy one a year. Personally, I don't like investing into tons and tons and tons of real estate. I like to keep it simple. Exactly. Right. I like to keep it simple. I've got my primary residence and investment property.
And you're not getting a call from the bank with a due on sale clause. Exactly. You have to hurry and navigate and dump a bunch of money. Like, it turns into a nightmare. So sometimes less can be more if you do it as strategically as possible.
Yep.
Which is good. So I like that segue. One thing we promoted recently at a realtor event was every person in the United States, let's just caveat that qualifies, can literally create generational wealth and only buy 2 homes ever in their life. And we like to say that to TJ's point, because so much of real estate is over glamorized. Like, you've got to be this flipper. You got to get, 50 seller finance deals. You have to be Grant Cardone. Like, you don't have to do that. And here's what we did. I'll just run through the quick scenario and then we can just riff on it a little bit. We said, all right, let's assume there's a first-time home buyer, married couple. They each make $60,000 a year, salaries, so $120,000 in total household income. They have some debt, so some student loans, some auto loans, and some credit cards. All that debt totals about $80,000, and it totals nearly about $1,500 a month. They've got $15,000 saved in their 401k, and they have $25,000 in the bank, just in the money market account for a down payment. They buy a townhouse in Salt Lake County. We had to choose that so we could run some analytics. They buy it for $450,000, which is highly feasible. And what I was going to say a moment ago, we know a builder that will give you a 9% discount right now on a brand new home, which is nuts. So if you are interested in that, call us. But $450,000 townhome, not out of the realm of reality. Down payment, 3% down, fully feasible with a first-time home buyer couple, easy. Closing costs, we say $7,500. So they let me just back up. That's just kind of the data points. Bought a $450K house, put 3% down, paid $7,500 towards closing costs. That's $20,500 out of pocket. Well, they had $25,000 sitting in the bank. So they still have $4,000 in the bank for reserves or furnishings.
Which this is all pretty conservative in today's market. I mean,
this is like realistic. In fact, we see people that are more qualified than this all the time. This is not like a...
Yeah, and I would bet that on this house, you'd be probably getting those closing costs paid for.
Exactly. So plus you have your 401k, so you got plenty of reserves. To TJ's point, you may have dramatically more than that in reserves because the seller, at least half the time, seller's paying for all the closing costs and buying the rate down, which we didn't even account for any of that in this scenario, just so you know. Total payment on that is $34.33 per month. Total monthly payments, including their other debt, which, like I said, was about $1,500, is $48.83 per month. Let's say they buy this first home and they hold that house for 7 years. Are we clear to move on?
Yeah.
We didn't miss anything.
No, it's cool with me, yep.
In 7 years, that $450,000 house is worth $614,000 based on the 67-year average appreciation rate in Salt Lake County. Right now, I think we have sandbagged a catapulting amount of appreciation within the next 5 years. Somewhere in the next 5 years, in my opinion, we see like COVID level appreciation at some point.
I agree. I agree with that.
This is not baking that in at all. This is very conservative to the point. Yeah. That house is worth $614,000 in 7 years. So step 2, you liquidate the house. That's the next step. So sell the home at $614,000. We just calculated as rough math. This is how we run it. 7% of the sales price in costs to you as the seller. So you have $43,000 in costs. Your mortgage balance, assuming you never refinanced, you kept the high rate that you could get today, and they never came down, you never refinanced, you owe $395,000. So once everything's paid off, this married couple netted in their pocket $176,000 in cash. The beauty is that is tax-free money, because on real estate, if you sell a primary residence that you've occupied for at least 2 of the last 5 years, you can profit $250,000 and pay, or excuse me, $500,000 as a married couple and pay 0 in taxes. This was only $176,000. I say only because it's comparatively to that 500, but no taxes. So what do you do with that money? Pay off the remaining debt. We're assuming they paid their regular monthly payments, no extra payments ever to any debt. And in 7 years, they got $23,000 remaining of the approximate like $80,000 in debt they had to begin with. So we first wipe out all that debt. Now they upgrade to a $750,000 home. So this is a 20% upgrade in home.
Yeah, which was also strategic by wiping out the other debt. Like if you have any excess debt left over, when you sell, pay off the debt. Because,
first.
Yep, that's the first thing you should do, because now you've optimized and you're going to maximize, because your new interest that you're paying is all tax deductible.
Yep. Right. And the other debt is not tax deductible. So that's the first step we make with people, which is kind of getting into our strategies. Like, and there's so much to it. It's so hard to like get it all out.
It all weaves.
Kind of hyped about it. But anyway, upgrade to the home. We paid off the debt first. That's like strategy number 1. Upgrade to a 750 home. So you have a 25% price upgrade from the home you're selling to the new home. 25% upgrade. We said, let's do 10% down this time instead of 3. You don't have to. You could do 3% down again if you had more debt or something like that. But just conservatively speaking, 10% down on that home, pay $10,000 in closing costs, we said. So we're being very conservative here. That's $85,000 into that new home, $23,000 in paid off debt. From the $176,000, you still have $68,000 in cash in your pocket to go reinvest elsewhere. You could reinvest this in another property. You could reinvest this in, which we ran, into the stock market, for example. It's most simple for us to run that scenario. So we just said, hypothetically, you put it in the S&P 500. Well, that's $68,000 invested. The total monthly payments with this upgrade, compared to the monthly payments they had when they bought the first house 7 years prior, are actually $50 per month less than the payments were when they were first-time homebuyers. And now they're 100% debt-free.
Right, but when you factor in the tax deductions, they're actually going to be less than.
Probably dramatically less than. It depends on what rates are at, but like it could be way less, because to your point, we've eliminated all non-mortgage debt, and now mortgage debt is tax deductible and can create hundreds of dollars per month in savings.
And you're living in a nicer house.
Right, a dramatically nicer house. So a couple little things. The return on investment. So you invested $20,500 when you bought when this couple bought the first home that they purchased, and they profited $176,000. That's an 838% return on investment, or equivalent to 119% per year cash on cash return. So they're more than doubling their money every year on average, like 1.2x their money every year on average, by just buying a home and making a mortgage payment. And that's $25,000 per year in profit on average.
Relatively speaking, that doesn't exist anywhere else with as safe as real estate is.
And to your point, again, we should layer this point on again. I haven't accounted for the fact that they saved on income taxes by owning the real estate instead. This is very conservative appreciation rates. Like this is like base case. It's crazy. So anyway, step 2, liquidate and reinvest. You bought your new home. Now what happens? So now we move on to the next step. So in 30 years, we just fast forward 30 years. So you buy a house as a first-time home buyer, get yourself some liquidity so that you can reinvest, have some more flexible financial options, and then you buy the new home and you pay it off over 30 years and raise your family, so on and so forth. That home that is now going to be free and clear, that cost you less money in total monthly payments than the debt you had when you were a first-time home buyer, that home is now worth, that $750K home is worth it's over $2.8 million in 30 years. It's worth $2,841,425, assuming 67-year average appreciation rates. So it's totally logical to say it's going to retain that.
And by this time, you should have it paid off.
Well, it's 30 years down the road, right? So as long as you weren't reckless with your money, but maybe you refinanced and reinvested elsewhere. So this could be even bigger than what we're saying. But theoretically, to your point, it's paid off. $2.8 million house. The money, the 68 grand that you put in the S&P 500, that has grown, assuming you did nothing else but put it in there and let the dividends reinvest and just let it go. We assumed a 10% annual return. The long-term average on the S&P 500, I think, is like 11.7.
Almost 12%, yeah, since 1952. Yeah,
so we are being conservative in that number, 10% annual return. Reinvest the dividends. That 68 grand turns into $1,186,559. So just the cash, you are over $1 million in cash by just choosing to invest $68,000 when you sold your house and just let it ride, do nothing else.
Rule of 5%, what is that?
You're making $5 grand a month after taxes at retirement 30 years down the road. And bear in mind, this first-time homebuyers could be 25, so they got into that second home at 32, and they paid it off in 30 years. So they're 62 years old, and they have $5,000 in after-tax
So they could not
income.
even be retired yet, technically. They're not even 65.
Yeah. $5 grand a month in passive after-tax income.
Do you take that into consideration? Maybe you've got a 401k. Maybe you're just working a standard W-2 job that they'll match. And then Social Security on top of that, if it still exists by then. You're living a damn good life.
Insane.
I'm 65.
Because remember, there's no taxes on that that's after tax on that $5 grand. Now, the other thing is that I like to think about for people is 30 years down the road, you've got kids raised. You're kind of going into a different phase of life. You may not want that big old house. You may want to downsize to a condo. Now, granted, the condo is going to be much more expensive 30 years down the road, but you got $2.8 million. So say the condo's $1 million. You sell your house, you got $1.8 million, and you had 1.1. So now you're talking like 15 grand a month in passive income.
And we felt that maybe
and a free and clear house.
You're never touching the principal with that $5 grand a month or that 5%. The real 5%.
Point.
It's still growing in your favor.
So to reverse back, that 1.2 million approximately that was in the S&P 500, we're saying you could get at 30 years down the road, you could pull $5 grand a month after taxes, net in your pocket every month. And the point TJ's making, that $1.2 million never gets touched. So if you die and you only take the $5 grand a month, your kids get to split that $5 grand a month forever and ever. When they die, your grandkids get to split that $5 grand a month forever and ever, unless it grows even beyond that.
And that is generational wealth.
100%. And all you did was buy 2 houses.
And this is in 2025 with rates the way they are right
now. This is 2025 metrics, 2025 prices. It's insane. Wild, wild, wild. Now, the other one that we could touch on is our other strategy that we like to talk about, which is the, what the heck? Why am I drawing a blank? Yeah. So it's the rental portfolio loop is what we call it.
Yeah. So while you're pulling up the metrics on it, essentially what he's doing instead of reinvesting into or investing into the stock market once you sell that first house is, you're talking about buying a primary.
Yeah, I'm talking about buying. So, okay, you should actually hit on that point.
Okay, so you could also take the funds instead of investing in instead of investing in the S&P 500, take that and purchase a investment property.
Which an investment property was 68 grand. You're buying a $320,000 condo or something.
Yeah, a great first investment property. Maybe you're not cash flowing, maybe you are. That's where it kind of dives into our first step in the conversation. But you'll have to run the metrics for yourself. But can you make money on the appreciation? Can you cash flow from it?
The crazy thing is over 30 years, like if we pull up that compound interest calculator and let's just say let's just say it's a $300,000 condo. What is that worth 30 years down the road if you bought that? And granted, you've also got the cash flow to your point, because certainly in 30 years it's going to cash flow. This becomes a much more complicated conversation, which is why we always start with the S&P 500 and then go into some of this other stuff later. But let's just say it appreciates at the 4.5% every year for 30 years. They bought the $300K condo, and we're going to say, let's see, calculate. So that condo is worth $1.12 million. So it's worth almost the same amount as the S&P 500 cash would have been worth. However, over those years, you would have been appreciating, or the rent would have been growing substantially. So you probably had the point is that could be an even more profitable route because you have tax benefits that are way better than the S&P 500, and you have cash flow. If it's not immediate, that cash flow over a decade or 15 years is going to be, we're talking thousands of dollars in income that comes.
Well, I think the run between like 2014, and don't quote me on this, this is not exact, but from like 2014 to 2024, the average rental increase in our marketplace is like 4.4% every single year. So in a booming market, your rents are going to go up every year, and you're going to continue to cash flow more and more.
So I just asked chat that question real quick because it is significant. Like I think it was like 5% per year.
Was it?
Yeah, I think on average. So yeah, an average of 5% per year, which includes some slow years, but some banner breakout years.
Yeah.
So now you think about it, that 300K condo, let's just say you're renting that thing for $1,800 a month right now, which seems pretty realistic. And let's just say the rent grows at 4% per year. So we're going to shave 1% off of that average. Yeah. Now in 30 years, it's crazy. These numbers work out the same as the S&P 500 practically. In 30 years, that rent, it's a free and clear condo now. You have $1 some odd million in assets, just like the S&P 500, and you're making $5,800 a month in rent. So you're probably netting $5,000 or so in rent. So it kind of works out the same. So it's like whatever path you want to go,
whatever fills your cup more.
There's a lot of options. But then the last thing to close up with is the rental portfolio loop, because you mentioned that. But this is something we get really excited about with clients. And to your point, you don't need to buy dozens of houses. You just buy a few. But for those that want that rental portfolio to create passive income faster, because that's the thing about a rental portfolio, is you can create passive income much quicker than if you just buy the 2 houses, throw it in the... That's more of the long-term approach. Yes. You're going to deal with the housing. You know, there is more risk, though, because you own more houses.
I do like owning your first home for a couple of years before you then start buying investment properties. And reason being, I like to build... especially if it's in a slower equity year, I want you to build equity in that home first so you can leverage it for down payment on the second home. That way you're not having to come out of pocket. Of course, if you can save and you can come out of pocket for a larger down payment, by all means, let's do it. Like that should be
even if you've saved, but you've got some equity. Like I just met with some clients this week and we did a consultation. They're doing just this, turning their primary into an investment, and they're buying a new primary. They have enough equity, they can go get a HELOC.
That's exactly.
They're not even going to use the HELOC because they have cash saved for a down payment, which so many people do. But I'm like, you guys go get that HELOC now while it's your primary home.
Better terms,
more access. They're going to have $150,000 in liquid access to mitigate risk. That's the crazy thing. The funny thing that I'm just realizing in our conversation now, what I think we do extraordinarily well is we recognize we have foresight for the risks, and we understand how to mitigate those risks. That's what I think we do above anybody else. And that's what makes these strategies so soundproof, because you almost can't fail if you're proactive enough.
Exactly. So to your point, take out the HELOC. That HELOC, you don't have to use it, but if you want, that can be used as funds for the down payment on the next property with as little as 3 to 5% down. So you then rinse and repeat. Just do that over and over again.
So the idea is you just buy a primary home, live in it for a year, rent it out. You have primary residence terms. You have to live in it for a year. Even so, if you refinance, it's a year from that refinance too, mind you. But live in it for a year after you got your loan, move out, rent it out,
get a new HELOC. It's literally rinse and repeat. Gives you access to more and more funds. To keep
You're growing liquidity. You're getting new houses. You can probably upgrade. You're only putting 5% down. Let's just choose 5. It could be less than that, or it could be more than that, of course. But 5% down is pretty realistic. And you have investment properties that you've invested 5% down in instead of 20 or 25% down in.
And then this opens the door into then investing into other areas, because now you've got so much leverage on these properties. Can you invest into the Grant Cardone types style of investments?
For sure. I mean, like I said, that's literally how I started. I started owning a few properties, invested that into some commercial real estate, sold that, and invested it into these bigger types of deals where it is so, I don't have to do, there's almost no risk. I mean, and I'm a pretty high risk tolerance person, but it's just, I don't know, there's so many options. I don't want to get on a tangent there.
And I think it creates simple investing too, where it doesn't take up hours upon hours of day. That way we can focus on our craft with helping more and more people.
And you know what I like about it? Like why I've transitioned into that type of investing as I think through here, because I didn't want to get on a tangent, but what I like is I get to invest my time and energy into researching the real estate opportunities, the details around real estate, guiding people on investing in real estate rather than managing the property, getting the new washer and dryer. I don't have to deal with any of that crap. So like over time, you can create It just allows you to scale at a much better
evolve.
pace because you're not the operator. Instead, you are the strategic expert and investor, right? Strategic. So anyway, becoming a millionaire and a path to retirement in real estate in 2025 and beyond, I don't think this will ever go away. 100%. I think it is the cleanest, most certain path to a multi-million-dollar retirement that exists.
Amen.
So hopefully we blew your mind. Hopefully you were thinking you can't create millions in real estate in 2025 and it was a dead game and you wanted us to affirm that and we didn't. And now you're excited to buy. Call us. We would love to help. We would love to be that advisor, the yin or the yang. You need a couple of them. You need counterpoints here. But this is what we get excited about. It's what we know. It's what we love. So if this was enjoyable for you, please share this with friends as well. Like and subscribe. Follow us on all platforms at Loans Elevated. You can go to loanselevated.com.
And if you've got a better strategy, put it in the comments because share the wealth.
I dare you. I dare you. If you want to argue with us, we'll actually just bring you onto the show and we can argue live.
There
which
you go.
Would be awesome.
Please.
Okay. We're
Thanks.
out.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.